When the global financial system stood on the edge of collapse in 2008, the rescue came fast and loud. Banks were saved, markets were stabilized. Governments intervened at a scale never seen before. And when the dust settled, the world was told a comforting story: that the danger had passed, that the system had been fixed, that the risk was gone. But that story was never true, because risk doesn't disappear when it's rescued. It adapts. What followed the crisis was not an era of financial safety. It was an era of financial redesign. New rules were written, yes. Capital requirements increased. Stress tests were introduced. But beneath the surface, something far more important happened. Risk was not destroyed. It was relocated. In the years after the crash, central banks around the world took extraordinary measures. Interest rates were pushed to near zero. Trillions of dollars were injected into the financial system through bond buying programs and emergency lending facilities. This flood of cheap money was meant to stabilize the economy. And at first, it worked. Markets recovered, asset prices rose, confidence returned. But cheap money has a hidden cost. When borrowing becomes effortless, debt becomes invisible. When returns disappear, speculation fills the gap. And when losses are backstopped, discipline fades. The financial system began to change its shape. Traditional banks, once the heart of systemic risk, were now heavily regulated and closely monitored. So, the most aggressive risk-taking didn't stop. It moved elsewhere, into hedge funds that operated beyond public scrutiny, into private equity firms using massive leverage, into shadow banking institutions that performed bank-like functions without bank-like oversight. Risk didn't shrink, it slipped into darker corners. At the same time, markets became increasingly financialized. Complex products multiplied. Derivatives grew more intricate. Algorithms replaced human judgment at speeds measured in microseconds. Trading was no longer about understanding value. It was about positioning for momentum. Exchange-traded funds promised diversification, but quietly concentrated exposure. Volatility selling strategies delivered steady returns until volatility returned. Corporate debt surged as companies borrowed not to invest, but to engineer higher stock prices. Everything appeared calm, too calm, because stability created by force is not stability at all. It is suppression. Volatility didn't disappear from markets after 2008. It was crushed. Central banks became the market's safety net. Every downturn was met with intervention. Every shock was softened. Every panic was absorbed. And slowly, investors learned a dangerous lesson. That risk no longer mattered. Bad news became good news. Weak data meant more stimulus. Failure became improbable, but risk cannot be erased by confidence. It accumulates. Like pressure behind a dam, the longer it's contained, the more destructive the release becomes. Small cracks began to appear, flash crashes that wiped out billions in seconds. Liquidity freezes in supposedly safe markets. Sudden collapses of institutions no one believed were vulnerable. Each event was dismissed. An anomaly, a technical issue, a one-off failure. But together, they told a different story. The system had become tightly interconnected, so complex that no single entity fully understood it. A shock in one corner could cascade globally before anyone had time to react. A margin call here, a forced liquidation there, a feedback loop triggered by machines responding to machines. Speed replaced judgment, and speed amplifies mistakes. What made this new era especially dangerous wasn't greed alone. It was trust. Trust in models, trust in central banks, trust in the belief that someone, somewhere, had the system under control. But history has a brutal consistency. Every major financial collapse was preceded by the belief that collapse was impossible. That belief is the true systemic risk. Because when danger feels invisible, it grows unchecked. And when it finally surfaces, it doesn't arrive gently. It arrives everywhere at once. The question facing the modern financial system is not whether risk exists. It always does. The question is whether the system has become so dependent on intervention that it can no longer survive without it. Because the decisions made to save the world after the last crisis did more than stabilize markets. They reshaped incentives. They taught institutions that survival was guaranteed and consequences were optional. And that lesson would come back to haunt the system. The risk never left. It evolved, and what followed would test the system again in ways no one expected. Welcome to Cash and Chronicles, where money, power, and history collide.